Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Welcome to this week's Through the Noise podcast. I'm Michelle, the host for today, and as we approach year end, it is that time of the year for self-reflection. As investors, it is time to review our portfolios and see how they have fared and what lessons we can draw from their performance. So, in today's episode, I'm joined by Rajat Bhattacharya, our senior investment strategist, to look back on the major events that have happened this year and our investment views going forward. Hi, Rajat. It has been a very eventful year. We've seen events like the tech stock rally, geopolitical concerns, etc. Would you share how have our strategies performed this year?
Sure, Michelle. Yes, our diversified investment strategies are actually on pace to deliver another year of solid returns despite the heightened uncertainty that you mentioned. The strong performance in 2025 underscores the value of smart diversification, I must emphasize. In fact, our diversified strategies have overcome a year of marked geopolitical and economic shocks. We had US President Trump raising tariffs to the highest in almost a century, Germany making a historic fiscal policy U turn, and China's deflation pressures deepening. Amidst all of this, our balanced strategy, which is geared for investors willing to take moderate risks, has delivered 16% total return so far this year, following more than 10% return in 2024 and more than 11% return in 2023. Meanwhile, our growth strategy, which is geared for investors willing to take aggressive risks, has delivered almost 19% total return so far this year, following almost 13% return both in 2024 and 2023.
Got it. So, what has driven this outperformance, and do you see this continuing?
Yes, our strong conviction on gold and equities for most of the year actually paid off handsomely, I must say, as both assets are on pace to outperform bonds and cash. In fact, gold is in line to outpace global bonds for the 10th straight year. Gold is also in line to beat global stocks for the fourth time in the past 6 years. Now, going into 2026, we retain our strong conviction on gold and equities on expectations of sustained emerging market central bank gold purchases and amid Fed rate cuts delivering a US economic soft landing. Meanwhile, we also expect the AI powered corporate earnings growth to continue. Elevated US equity valuations and challenges to the AI narrative can lead to bouts of volatility, of course, but we would add exposure on dips. We also remain bullish on Asia ex Japan equities with preference for China and India, which offer compelling valuations and growth opportunities respectively.
Definitely. So let's look at Asia ex Japan equities in a little bit more details. Why were we bullish and what are the opportunities?
Yeah, we see compelling opportunities in both China and India, actually, as I mentioned there. So now China's offshore equities delivered strong Q3 earnings with 2026 projected EPS growth at 11%. We expect Chinese equities to continue to re-rate higher with government policy support and corporate AI investments as the key drivers. The new 5 year plan that was just unveiled emphasized boosting services consumption and achieving technological self reliance. Additional stimulus could also be announced at the upcoming Central Economic Work Conference meeting, which would likely support a year end rally. Meanwhile, we also expect investors to refocus on Indian equities. The market's valuation premium has moderated year to date amid a profit growth slowdown and tariff headwinds, but those headwinds are fading. GDP growth at 8.2% year on year in the quarter that just ended in September far exceeded estimates. Now, recent monetary policy easing plus tax reforms offer support to economic growth and provide a foundation to revitalize earnings growth. The earnings revision index for India has been improving and has been recovering from negative territory actually, with 12-month forward EPS growth at 15.5%, which is outpacing that of most regional players in Asia.
Got it. So outside of Asia, you've almost mentioned that we're still bullish on the US equities. Do you see any risk on that?
Yeah, we remain broadly constructive on US equities for another year. Now, a key risk, of course, is any threat to the AI narrative, including concerns about high capex spending and how the investments are financed, and of course, the slowing down of returns on investment. Strong cash flows from US tech giants finances the capex today. A severe growth slowdown could impact the tech giants' cash flows and their willingness to invest in AI applications. Our base case, which is a soft landing in the US economy, would sustain cash flows for the tech giants, in turn supporting the AI investments. We do expect almost a 15% earnings growth in 2026, led by the technology sector, which would drive US equities higher. We do acknowledge valuations today are elevated, and history suggests that this means we should expect higher volatility in the year ahead. However, our positive view on economic and earnings growth means we would see such volatility as opportunities actually to add to US equities.
Got it. So in that case, are there any signposts that investors should look for in the coming weeks?
Yeah, actually, while the last 2 weeks of the year are historically the best for equity markets, especially in the US, five events I should highlight over the coming weeks have the potential to raise volatility. The first one is the Fed policy meeting on 10th December. The second is US data deluge after the Fed meeting, including the delayed jobs and inflation reports for November. Third is President Trump's nomination of the next Fed chair. Fourth, a Supreme Court decision, which is likely in December or in January probably, on the legality of Trump's tariffs and the firing of Fed Governor Cook. And finally, the BOJ policy decision on 19 December. Now, on the Fed, markets are almost pricing in a full 25 basis points rate cut at the policy meeting next week. Although initial jobless claims are subdued, concerns remain about a slowing pace of hiring. This was reinforced by a contraction in private payrolls from the ADP data and contractionary employment indicators from the ISM PMIs, which is raising the chance of a rate cut next week. Now, focus will turn to the Fed's revised rate forecasts and the extent of the divide amongst policymakers. We know the Fed is very divided on the next what to do next with the rate cuts, or whether to cut again. We expect rising rate differentials as the Fed cuts rates next year, while the ECB holds rates to lift the euro over the dollar towards 1.18. Now, other potential hiccups include any hawkish guidance next week from Fed Chair Powell or from the Fed's updated forecasts, which could lead to a renewed dollar rebound. But that kind of rebound is likely to be temporary. Ultimately, we expect Trump to shortly name a Fed chair who is likely to keep rates highly accommodative, reviving concerns about the Fed's independence. This should eventually drive the dollar lower. In the same vein, I should add a Supreme Court decision to uphold tariffs could upset markets which are expecting a significant part of the tariffs to be struck down.
Got it. So one last question is about Japan. How should investors react to the rising Japanese bond yields, and what is our view about the yen?
Sure. Now, Japanese long term bond yields have been climbing to multi decade highs, with the 30-year yield actually breaking out into a new record. Now, the yields are likely to climb higher as markets price in more BOJ rate hikes, including a potential increase this month amid rising inflation and wage pressures. We see potential for the dollar yen as a result, testing the 153 support level in the near term. A hawkish BOJ turn could put the JPY carry trade, in other words, investments fueled by the borrowing in yen, at a risk. Now, we discuss a lot of this. I must conclude by saying that we discuss a lot of this in our annual outlook for 2026, which is going to be published on 12 December. And there we talk about these challenges and the benefits that are emerging from these market volatility in the coming year.
Sure, we'll definitely check this out. That's all we have for today. Thanks so much, Rajat, for your sharing, and thank you, listeners, for joining us. As we conclude today's session, please don't forget to like and subscribe if you're interested to know more about the latest investment trends. We'll see you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.